So when is the right time to sell your business?
A seller should really think at least 2 years ahead of time to prepare for a sale. It's very important. And frankly, there are a lot of people, and I'm a firm believer in this, every day you should look at your business as if you're going to exit tomorrow. And when you do that, you will work on the things that make your business more valuable. Okay.
And another earmark that, people are looking for is obviously EBITDA. So people want to know whether or not the company is profitable. And they also might be looking for growth. So an earmark of a really great candidate for sale would be one that has profit and is growing. But you don't need to be growing if you have at least EBITDA and a very mature internal professionalized management team.
We typically like to see service businesses with a minimum of about 25% EBITDA margin. In a products business, if it's manufacturing, maybe we'll see 15%. If it's a service-related business, we like to see high recurring revenues of at least 60%, whether it's subscription or contract revenue. What is really defined as a professionalized management team. They're running the business on a normalized basis, not as a lifestyle business. So that's really, really important. I know I personally have seen business owners where they're running QuickBooks and they're running their business and personal expenses and income through the same set of books. I see that a lot. The next point is clean set of books using corporate software like White Plains, NetSuite, SAP, and alike. If you can somehow minimize, we like to see, as an ideal candidate, we'd like to see low customer concentration. Some businesses can't get around government regulatory liabilities like healthcare services businesses. So, you really can't get around that, but you want to try to minimize those regulatory liabilities the best you can. I'm also stating the obvious, but no current or near-term litigation or employment matters. It's going to happen when it happens, So we also an ideal candidate for us is a company that's domiciled in North America. It's okay if they have operations or revenue from international locales, but we like to see companies that are domiciled in North America.
And any other comment about ownership of either intellectual property because I think it's a fair thing that affects valuations and whether or not some companies
absolutely.
Work towards that.
Ownership of IP is critical. If you think about it, probably 80% of a balance sheet of a private or public company is really made up of intellectual property. However, if you haven't acquired the intellectual property through an outright acquisition, that's never going to show up on your balance sheet. So that's one of the things as valuation experts that we look into because we value a lot of intellectual property.
Yes. And I'm even thinking of the product-based businesses that are watching. There's IP in the recipes, making sure that you're not just private labeling a product where you don't even know what you're making. Or if you don't own, ideally, if you own a factory, that is an asset that you guys would value. But if you don't own a factory, at least you have the processes in place. You own relationships. The amount of ownership is really important to be definable and measurable. So that way, when you're transferring it to someone who's not you, you're no longer working and employed at that company that you built. The person who owns it can still continue to run it.
Right. And use the IP.